Welcome back to Credit Nerdery, presented to you by Kyron Financial. It's your boy Genius, back with you with another one. I just want to have a brief conversation with you about charge-off. And what is a charge-off? There is a lot of misunderstanding about what a charge-off is. So I just want to add some clarity to your understanding on what is a charge-off and why you have a charge-off. Welcome back to our channel. A charge-off is an account that the creditor was not able to collect. Creditor was not able to collect on an account, a debt, a credit account, or a debt, and they have to charge it off. The charge-off was made because under certain business rules. Now, not under credit, but under certain business rules, when a company generates revenue or have receivables, they have to do certain kind of accounting. So there are laws that govern business that tell you that if you have a debt and after 180 days you're not able to collect on the debt, you have to get that debt off your books. And that's where they move it from being an asset to a liability, from being something that is collectible to something that is incollectible. And that's when it becomes a charge-off. That is why it has to be 180 days. 180 days is not by accident. You notice all companies, after 180 days, they charge it off. Because that is the rules that govern business accounting and tax purposes, and also for the credibility of a company's accounting representation. So it makes no sense if you have a business and you're going to say, all right, I have $10,000 in assets, but the $10,000, no one has paid on it for 6 months. Then that is not something that you're likely going to get payment for. So under business rules, they have to actually put it to profit or loss. So that's what a charge-off really is. Now, there is a conversation that is being had over and over online and in credit forums, stuff like that, where they make the argument that a charge-off are not supposed to be on your credit report because the charge-off is income. That's not necessarily true. The FCRA, which is the Fair Credit Reporting Act, specifies that a charge-off can be on your credit report. And a charge-off is not automatically income, okay? It's not automatically income. And even if the charge-off is actually becomes income, because what end up happens is that the IRS rules have it where any company writes off anything above $600, they should issue you a 1099. They don't have to do it, but they should. When they do that, it becomes counted by the IRS as taxable income. Once it becomes taxable income, you are able to pay the taxes on it, and then you can try sometime to get the charge-off off. But it does not necessarily mean that the charge-off will come off. The charge-off can be updated to show that this account was a charge-off and it is now paid off, which would then allow the account to fall under being accurate and complete. If the account is paid off but still reported to have a debt and is charged off, then that's when you have inaccuracy. But if the creditor or the collector or the credit bureau that is furnished the information by the creditor or the collector that you have paid it, they can update it to being paid. And it is legal to report it that way. Okay? So if you hear that a charge-off is income and therefore it cannot be reported, that's not true. The FCRA make it clear when it deals with the life of the data that is on your credit report. It doesn't refer to it as charge-off. It refers to it as profit or loss, which is what a charge-off is. And a charge-off is able to stay on your credit report for 7 years from the date of your first delinquency, right? Doesn't matter whether or not you pay it. If you pay it, it can be updated that it was charged off and it's now paid, and that would be complete and accurate reporting. All right? So let me clarify that. And a charge-off is not automatically income. And even if it becomes income, it still can be reported on your credit report. Because all it says is that they issued you a 1099 in order for you to comply with basically tax purposes, where the IRS get their cut out of that debt that was generated that you now actually is write off by the company. So let me make that clear to you. Can a charge-off be a collection? Yes. There is also an argument that a charge-off cannot be a collection. That's not true. Because when the charge-off is charged off by the creditor, right, it does not mean that collections activity automatically cease. They still can legally collect for the debt that you owe them. What it means is that they no longer will represent that on their balance sheet as something that is an asset or profit. That's all that is. It does not mean that you are not liable to still pay the charge-off. Yes, you can. And they can outsource it to a collection agency to still collect for it, or they can sell the account, and that is legal also. So let no one tell you that a charge-off should not be on your credit report because it's income. That's not true. And even if you file the taxes and pay taxes on it, they still can collect on it. They still can collect on it. Whether a collector, if they sell the account, or whether there is the original creditor that actually still has the account and might outsource the collection, or they themselves want to try and collect. Even if, watch this, let me even get deeper. Even if the statute of limitation expires on the charge-off, they still can attempt to collect from you. Why they can? What does the statute of limitation do? The statute of limitation just put you in a position where they cannot carry you to court to collect on the debt. That's all the statute of limitation does for you. Some states, however, as consumer protection statutes, that once the debt is out of the statute of limitation, whether 5-year, 3-year, 2-year, whatever, depending on the state, it is different. Some states make it where the collector cannot collect on it, period. So, but the federal law doesn't say that. So you have to know, and every state doesn't actually say that as well. So you need to know that whether your state has the statute of limitation that says also that once it reaches the statute of limitation, you can actually collect on the debt. Some state does have that, but not every state. But even when the statute of limitation expires on the collectible, the collection of the debt, all that just says is that they cannot sue you for it in court, but they still can attempt to collect the debt, as long as the state law doesn't say that. The federal law doesn't stop that from happening either. So let me just wrap up. The charge-off is an account that is 180 days past due, and the creditor decides to charge off the account, to move it to their loss, liability section, and get rid of that account of their balance sheet as something that is collectible. And that's what makes it a charge-off. Once it becomes that, they can either collect on it, still attempt to collect on it, they can sell it to a collector, or they can hire a collector to do the collection activity for them, and they also can issue you the 1099, and you file taxes on it. Even after you file taxes on it, they can still attempt to collect on it. Okay? All it says is that it has become classified for IRS tax purposes. IRS reckon that as income, but the collector can still legally try and collect. Anyone that says that charge-off, once it's on your credit report and once it's a collection, it is illegal, is not properly representing what a charge-off is and how charge-off works. The FCRA, under the section that deal with the aging of accounts and when an account becomes obsolete, being reported on your credit report, specifically mention charge-offs. So charge-offs can be on your credit report and they can be also collections account. There's nothing illegal about it being listed as a charge-off and a collection. When you actually file that return, even if you file the return for the charge-off, they can still have it on your credit report. What they would need to do is to update the charge-off as now paid, and then that would become complete and accurate reporting. Now, if you file the return, right, and pay the taxes on it, or you settle with the creditor or the collector, if they don't report that you have done that, then that becomes incomplete reporting, and that warrants it being deleted off your credit report. Everything that's on your credit report should be accurate and complete. And complete means the story behind what is there must accurately reflect all that is true concerning the given account that is reported. Once it doesn't mean accurate or complete, then that's how you can get it off. But that doesn't mean once you pay the taxes, it shouldn't be on your report. The derogatory remark can be there once they update it and reflect the status of the account. All right, I hope that was helpful in explaining to you the nature of charge-offs, because charge-offs are just accounts that are reckoned by the creditor or the collector as being not likely to be collected. So they charge it off their books, and that is the case for business-related purposes and rules that businesses have to follow when they come on to proper accounting. All right, have a wonderful day. Remember to like, share, and subscribe. Credit Nerdery. I'll see you on our next video. Peace.